Hello again. This is Josh Carr at The Real Angle, and today I'm speaking with Frank Rohde, CEO and founder of Ownify, and we're going to talk about an interesting business model today. Frank, how are you doing today?
I'm good. Thanks for having me.
Good. Thank you for joining me. The whole reason I started this podcast was I wanted to talk about things that were not just simply let's buy some garden apartments and rent them out,
Yeah.
So I've really sought out more interesting structures. So let's get into it. What is Ownify?
Ownify is a new on-ramp for first-time home buyers. And the best way to think about Ownify is it's an alternative to the mortgage for first-time home buyers looking to buy properties, homes in the US.
Okay. Okay. So
Okay.
structurally, like what's I guess let's start with the basics of mechanically what it is, because I mean
Yeah.
I've seen rent to own structures before, but I want to understand kind of what your secret sauce is, if you will.
Cool. So the big challenge for first-time buyers and buyers generally is really there are three things you need to be able to buy a home, right? One is income.
Sure.
Second one is decent credit, and the third one is usually savings for a down payment.
Okay.
And where Ownify helps buyers today is with the down payment. So we're targeting buyers who have decent income and decent credit, but haven't been able to save. And that proportion of buyers is actually getting larger and larger because home prices keep going up, the down payment keeps going up, right? Inflation,
Sure.
student debt is weighing on people's ability to save.
Housing affordability is a disaster right now nationwide. Yep.
It's really
Yeah, I
really
know.
hard, right? And I think it's not going to get any better anytime soon. We have a structural issue in the U.S. with supply, and we have mortgage rates who've reverted to the long run mean. I think in the fives and sixes, right?
Mm-hmm.
They're not going
Mm-hmm.
to be in the twos and threes. And so I think that just general environment, right, creates a structural issue around housing affordability, and that's really what we've been looking to solve. And the reason I got to this in the first place was I ran a software company for 15 years focused on mortgage pricing. We sold
Okay.
software to a lot of the large lenders globally in the US and Canada, UK, Australia, New Zealand, that was doing basically figuring out the math on how to price a mortgage
Okay.
for consumers. And
Based
as
on
part of
credit quality and all kinds of other things.
credit quality, income, capital markets, conditions, and
Got it. Got it.
competitive
Got it. Got
environment
it.
and all that. And as
Sure.
part of that, started seeing in the data this problem that first-time buyers are getting squeezed out of the market. And even those who can qualify for a mortgage, a lot of times can win deals because of financing contingencies or appraisal contingencies, right? And they're competing against corporate buyers who make all cash offers. And so, what we did with Ownify is we sat down and said, how do we rethink this on ramp and how do we rethink what it means to own in the US? And basically, when I say it's an alternative to the mortgage, what we figured out is how to allow people to buy a home, build equity in the home while living in the home without incurring the debt that's usually associated with buying a home.
Okay.
And the way we do that is that we fractionalize homes into 10,000 bricks, as we call them. And a brick is really a membership interest in an LLC that holds title to the home, right? And your
Got it.
audience will
Okay.
understand this,
Yeah,
right?
so you put the asset into an LLC. I assume you start with it being 100% owned by the landlord, and then over time, the tenant sort of buys in, if you will.
Yes, we start with 298 or 200 bricks that the
Okay.
customer, we
Okay.
call them the ONI, contributes, right? So that's the down payment, effectively 2%. And the fund or Ownify as the pool of investors contributes 9,800 of the bricks or membership interests, 10,000 bricks in every home.
Got it.
And over a 5-year program, two things happen. The customer pays rent on the bricks that they haven't bought,
Hmm.
and every month they buy incremental bricks. Um, and the way the math is dialed in is they work their way from 200 bricks on day one to 1,000 bricks at the end of 5 years. 1,000 of the 10,000 bricks is 10% of the value of the home, which is then enough to go out, use that as a down payment for a traditional mortgage. And they have the purchase option to then buy the home from the LLC at future market value. So really what we're
Got
allowing
it.
the
Okay.
customer to do is buy the home fractionally as equity rather than through debt.
To get from that 2% down to 10% down, basically.
Exactly.
And then once they're at the 10% down, so now let's say, okay, so I got it. So we agree, the house is worth, 500 grand. I'm putting in 2%, you're putting in 98%. We have an LLC, it goes on. I understand that there's a rent and the rent is tied to how many bricks we have left. So now let's say we're 5 years down the road. And as you said, I've got 10% of the bricks, you've got 90% of the bricks. I now go to finance this thing. We've got a purchase contract, so we know what I'm buying it for. Um, but I'm not really showing up. Sorry. Yep.
You don't. And I think one of the interesting things you said, we have a purchase contract, so you know what I'm buying it for. The whole thing is equity, so the value of the home
Okay.
is variable throughout the entire 5 years.
Okay. Right. So 5 years down the road, we agree I buy it for some future value, and the future value is determined by
AVM,
appraisal.
yeah,
Okay.
we do AVMs, and the way you build from 2 to 10%, so the 800 bricks you're buying along the way, those are also transacted at whatever current market value in every given month. So every month we revalue every home in the portfolio, and we sell to the customer the number of bricks at the then current market value, which has an interesting, you're a financial modeling guru, so you'll appreciate this,
Yeah.
which has an interesting dynamic. It basically means that the customer buys slightly more bricks on the dip of real estate values
Sure.
and slightly fewer bricks on the peaks.
It's dollar
And
cost averaging, just like with automatic
exactly,
stock plan. Now,
exactly.
now, one thing that interests me about this, like I understand what an appraisal is, and I get that. But when you talk about that, there's some sort of automatic value calculation type thing. How is that being calculated? Because imagine if I were a prospective buyer, my great question would be, well, that's fine. I'm buying bricks based on the value at that month. How is that value at the month determined?
Yeah. So the value on day one is the purchase price
Easy.
plus
Okay.
whatever, if there's improvements, those go into the purchase. So let's, for argument's
Sure.
sake, it's 400,000 on day one.
Okay.
1 month in, we pull three different AVMs or automated valuation models from three different independent providers. So this is
Got it.
not
Okay.
the whatever the fox guarding the hen house, but
It's
we
not
get
you
three.
coming up with the price. There's
It's
okay.
not us coming up with the price. It's three different providers. We
Okay.
take the average of the three. We add in, there's a declining calculation around the improvements we've made, but we strike the price in that month and say, okay, so in month one, we bought it for 400. Let's say it's now worth 402 for argument's sake,
Sure.
right? A month later, it might be worth 401 or 399 or what have you. So the price fluctuates every month, and we divide it by 10,000. That's the price of the brick. And so in that first month, let's say at 401, each brick is worth $40.10. That's your price at which you purchase some number of bricks. You make a fixed payment, which means the number of bricks is variable, hence the dollar cost averaging, just like you're buying shares in a mutual fund, right? Or your 401k.
Got that. So now let's say we're now 5 years down the road, and
Yep.
now the time comes that I want to buy the house and just own
Yep.
it, just like a normal person. I show up to the bank and I say I have a purchase contract because now I am buying it. I'm
Yep.
buying it for X amount of dollars,
Yep.
and I'm contributing my 10% ownership stake as my equity, essentially.
Correct.
Um, do you, I mean, how old of an entity are you, I guess? Have you got into that 5 year window of any
We
of these
haven't we
people yet?
haven't gotten to the exit.
Okay.
We're 2 years in, right, or two
Okay.
years old, and we started buying homes last year, so we don't have
Okay.
any exits yet.
So we haven't happened yet. Yeah. Because my real question would be I imagine if you came to a bank with this at the 5 year, I mean, it's definitely not something they've seen. They've seen it, but they haven't seen it. It's not as straightforward as just a normal you're buying a house and
Yep.
what have you. So that would be my only real question would be the market
So
acceptance of this from a lender standpoint.
yeah, so we've worked through this with a couple of lenders to make sure we have folks on deck, lenders
Okay.
on deck who can deal with this. And the way the lender views it is very similar to, let's say you put $500 a month into your E-Trade account, and at the end of 5 years you have X number of dollars in that E-Trade account, and you bought it
Right.
over time. What the lender really wants to see is, here's your dollar value that you're contributing, right? Here's the provenance of those dollars, and I need to
Right.
show you that I have them in this account, whatever
It
E-Trade's
was
are.
real money that I put in, that I saved, but
It's
instead of it being a savings account, it's like you were maintaining a savings account for
you
them,
put
essentially.
money into an
Yeah.
LLC. The
Right,
LLC
right, right,
happened
right.
to have title to the home that you lived in, and you were also a tenant of that LLC, right? But for the lender, at the end of the day, it's really about what's the provenance of that down payment. It's not a gift. It's not borrowed. That's the main thing they care about, right?
Sure,
It
sure.
is bona fide savings that you've built up over time. And one of the interesting things you mentioned, rent to own, right? My co-founder was CEO of a big rent to own company, and he's bought 5,000 homes in that structure. And one of the big things that customers are missing and aren't getting with rent to own is true ownership. So the piece that we worked on for a long time is, how do we create true ownership, right,
From
to the
day one,
customer from day
rather
one?
than rather than I rent it and eventually I have the ability to buy in. Yeah, yeah,
Correct.
yeah, yeah, yeah,
And so in the US today, at least, you can't fractionalize a
yeah.
title, or at least it's very hard, right? You run into trouble with every county courthouse, and their heads explode.
It's a mess.
Um,
No, they're not equipped for it. They're not equipped for it. Yeah,
but you
yeah,
can fractionalize. You can put it into an LLC, and you can distribute the membership and the ownership of that LLC in a creative way, and that's what we've done right through this model.
yeah. It's interesting. It's interesting. So you guys have been around for, yeah, as you said, I mean, you've been operating for about a year and change. I imagine there was some startup period before this.
Yep.
Um, how many houses do you have? Like
So we have
roughly how many?
we have
How big are you?
7 houses in the portfolio, all in
Okay.
Raleigh, Durham.
Okay.
We've got 15 or so in the pipeline. We're looking to be at 30-35 homes by the end of the year.
Right. And Raleigh Durham, you started with because you had a passion for Raleigh Durham? Like, why Raleigh
Barbecue.
Durham?
No.
Okay.
the So I'm from Germany, and I live in San Francisco. My co-founder lives in Maine. Right, our team is all over the U.S. But we basically built a model for the 300 or so real estate markets in the U.S. and looked at the core fundamentals. And Raleigh bubbled up to the top. Right,
Okay.
job creation, economic stability, house price appreciation, rental yields. It's just a really good market.
Okay.
And the market we're looking for, broadly speaking, are markets that where you can still buy starter homes in the three, four, $500,000 range, where you can generate enough of a rental yield on those homes to create an investor return, and where you have future home price appreciation, so that the investor return is partially rental yield and partially home price appreciation.
Got it. Got
Right,
it.
and that's kind of the screen that we apply to every other market as well.
Now, obviously, in a landlord tenant relationship, if I default, you evict me, what have you. Here, you have a contract with them over 5 years. Like, how do you handle defaults? Because that's always the question I have with a
Yeah.
situation like this.
So a default, there are three agreements that run in parallel. One
Okay.
is a tenancy agreement, right? And the tenancy agreement governs your ability to live in the home, occupancy rights, all that.
It's a
And that's
lease.
a
Yeah.
landlord-tenant relationship.
Sure.
And under that agreement, if you default, you get evicted eventually, right? Obviously, we try to work it out, etc.
No, but that's landlord tenant. Yeah, yeah.
That's landlord-tenant. The second agreement is an equity share agreement that governs your ability to purchase shares in the LLC that is also your landlord. So in a way, you're a shareholder of your landlord. Which, by the way, if you buy a co-op in New York, something similar happens, right?
Yeah.
Um, we do it for each individual
There's a
home.
proprietary lease, and yeah, with a co-op, you're an owner of a corporation, but then you have a proprietary lease that says you get some tenancy rights. Yeah, yeah,
Correct,
yeah, yeah.
exactly.
So it's not that dissimilar
It's
mechanically.
not so.
Okay.
So you have an equity share agreement, and to answer your question, Josh, when someone defaults, right, they can get evicted, etc. Under the lease agreement. The equity share, basically, what the equity share stipulates, that if you end your lease in whatever way, shape, or form because you default or because you end it by telling us, right, we will buy back your equity, and whatever number of bricks you've accumulated at that point in time will have a certain value. In fact, it's the value that we struck last month, right? We will buy back. We charge you a relisting fee that melts away through the 5-year agreement.
Sure.
And
Which
between those
makes
two
sense. Yeah.
components, right, the equity stake of the customer is protected and the interests of the investor are protected through this melt away provision.
Right. You're getting some fee for the aggravation and the hassle of having to deal with it, but mechanically, yeah. I get it. I get it.
Exactly.
No, it's
So,
it's an interesting structure. I mean, the lack of down payment is obviously huge in the United States. I mean, I'm teaching class this summer at Columbia, the real estate market analysis class, and you pull the data on housing in the United States, and you look at the Harvard, Journal on Housing and everybody else, and it's like big screaming, blinking lights, about housing affordability is bad, it's getting worse. And, the issue is that as it gets worse, it starts to have larger societal impacts. I mean, if you can't buy a house, how do you start a family? And if you don't start a family, then it has impacts with dot, 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 all the way down the line for pension plans and Social Security. No, it's a real issue. It's a real issue. And
and,
unfortunately, I
and
think, well, yeah, go ahead. Sorry.
and so one of the interesting things about the down payment, right? The way we've tried to solve it in the past, and I've lived through it, with Nomis as a participant, is people have low down payment or zero down payment mortgages. The issue with those zero down payment mortgages is that they create this moral hazard, right? Of someone puts nothing down and then their home price falls by 10%. Now they have an active incentive to walk away, send the keys
Sure.
to the bank, right? And that's
Sure.
what happened in 2009, 2010. And with the structure we've built, we've said, okay, you can put down very little and you're building equity, but because there's no leverage, there's no debt here, that equity will always be worth something, right? If you own 10% of a $300,000 home and the value goes to 250, your stake is still worth $25,000. You
You're
still
still
have
walking away
equity.
from real money. Yeah, yeah,
If
yeah,
you
yeah.
were to walk away, you would still walk away from your money, and so it takes away that moral hazard, right? This problem of people sending in the keys with a low down payment, and the mortgage math kind of falls apart at the 0% down payment structure, right? Because you
Mm-hmm.
can't charge enough interest to compensate for that risk.
No, and the moment, yeah, as you said, the moment values drop, there's no incentive to continue paying.
Yeah,
Right?
yeah.
It's just it doesn't make economic sense.
And so
No,
we've solved that problem through this equity structure, right?
no, it's an interesting structure. So you're doing stuff in Raleigh. You're growing. You're adding more houses to the pipeline. Your investors are investing in these houses, and I guess down the line, as they get some, they have some assets come to term, if you will. Hopefully, they reinvest in the rest of it. So, are you out there actively raising money for investor? Like, where are you? What is the issue for you now that you need more investors, or is the issue for you now you have more buyers for housing? Like, what's the thing that's stopping you from becoming a zillion-dollar entity, if you will?
Well, we're going to become a $1 zillion entity eventually. The
Sure.
question is, how fast can we get there?
But
And
right now, if I said to you, do you want investors or do you want house buyers for houses? What's the
so
immediate issue?
the immediate issue is more. We need more investors,
Okay,
right? But we're the way to grow this business is to balance the two,
sure. No, you
right?
can't. I mean, you can't have more of one and less of the other. It doesn't work. Yeah, yeah.
Correct. So we've launched Raleigh Durham. We're adding Charlotte. We're adding Nashville. Right.
Okay.
We're adding the rest of Tennessee, and then we're going to add Denver and other cities. And so the growth on the consumer side is metro by metro because we have a thesis on individual housing markets, and we want to leverage the agent network, the realtor networks in those markets for low cost acquisition. So that
Right,
means
which makes sense because they're the ones at the point of sale with the buyer, and the buyer is saying, I need a way to buy this house. And then the agent assumingly says, well, have you considered this product?
yeah, exactly. And they
Sure,
want a cash
sure,
offer and all that. So
sure.
we're doing that on the consumer side, and at the same time, we've raised a fund, the Ownify Home Fund, that accredited investors can put money into, and that promises or targets a 15% return. And so we're attracting capital there. And when you
Interesting.
ask me where's the constraint, today we're a little ahead on the fundraising side. Next month we're going to close on 3 or 4 homes, right? And we're going to be so it's that
Then,
balance
yeah.
on that, right? And as we get larger on both sides, the balancing gets easier. It's the when you start out small that you're really looking to balance those both sides of the business.
No, you have an illiquidity problem because you're not, or not illiquidity. The mismatching, there's a lot less mismatching problems when you got $500 million to play with. Interesting, interesting. No, it's definitely a fascinating model. It's definitely something that responds to the fact that right now down payments are a crisis, and sadly, I don't see that going away anytime soon. Like, this does not strike me as a problem that it will magically be solved in the next 18 months and the business thesis goes away, which is troubling. I mean, not for you, but for as a nation.
As
Um,
society,
yeah,
it is a troubling problem. And whenever you have a big societal problem, there are opportunities, right? And we're structuring an opportunity around this to say, let's rethink what it means to own. Let's create a different on ramp, right, for first time buyers that allows more of them to get into the real estate market, right, and build equity and build wealth, quite frankly, through property
sure,
ownership.
sure. That's interesting. So, from a team standpoint, how big of a team are you these days?
We're seven,
Okay.
distributed all over. And yeah, looking to again balanced VC investment for the opco for Ownify Inc. And then we have the Ownify Fund that is raising capital
Right, because
from
yeah,
equity investors.
and that's interesting. So yeah, so there's the operating business, which, as you alluded to, is VC backed, which is
Yep.
fine, and you grow, and there's probably another round that you'll do because that's just the nature of VC
Yep.
world. And then you have sort of these and these funds that people are investing in. Are they the investor side? Are they doing it like an evergreen fund, or is it like they're just doing like a tranche of money? It's closed end. How are you bringing them in?
It's a 5 year closed end fund.
Okay, fine.
With for accredited investors. It's a 25K minimum. And if I
Then
look
you
at
do
the
it again.
investor profile, it's some folks come in with their cash, some folks come in with their retirement accounts, and some folks come in with their donor advised funds. Given that
Mm,
there's a social impact component here, right? We've been qualified as DAF eligible, so you can use donor advised fund capital to put in. And I'd say more than half of the investors are driven by the impact and the story and the desire to have a positive impact on their community or on young people generally. um, and the other half are driven by, okay, 15% return in a low risk asset class, I'm excited about that.
and off we go.
um,
Yeah.
and off you go. Exactly.
No, it's curious. It's curious. I mean, not to, talk about competitors really, but I don't really know of many other player. I mean, the other players I know of are just rent to own guys. I don't know of anyone who's fractionalizing it the way you are, to be honest. And what I
I
like
don't.
about, sorry,
Yeah, I don't think so either. I think that you've seen fractional ownership in the past, usually around timeshare and vacation properties, right?
yeah,
You buy an eighth or a quarter or some number of weeks, or and so the model has existed in that structure. It hasn't really existed in the for the benefit of first time buyers, right? And then when you look at the rent to own models, as I mentioned, my co-founder worked for one of them. The big piece that was missing was that true ownership piece, and so we tried to figure out how do
yeah.
we build that, and that's kind of how the two merged, right? And when we talk to first time buyers, a lot of we say, hey, it's fractional ownership. They think, well, I don't need a rental, I don't need a vacation property. It's like, no, it's fractional ownership for the home that you live
For
in,
the home, right, 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 single family.
right?
Yeah, so it's more of an education issue at this point.
Correct, exactly.
I love the fact that we managed to go through this whole conversation, and at no point did you use the word blockchain. That makes me very happy because it seems that whenever anyone says let's fractionalize it, the next sentence out of their mouth is something about blockchain, which I find concerning because like you don't need that here. It's just simply
You don't really need it, right? I
right.
mean,
It's a
there's certain.
spreadsheet. You just say you used to own this much, now you own that much. I mean, it's not. We don't need to get fancy and techie for things like that. It's just you could do it with pen and paper. Frankly, it's just not
Yeah,
that hard.
yeah. I mean,
It's
and
not that
we've
hard.
honestly, we've built a portal where the customer sees their equity and they see the value of the bricks and all that, and the investment in making that look attractive and appealing to the oni is much more important than the ability to then put that on the blockchain, right? So that they can use some third party wallet to look up the same thing. So we've not invested on the blockchain side.
So I guess here's my last question on this, and then I don't want to dig too deep, but here's my last question. So I understand the way the person buys in and it works for them. I guess the way the investors make money is through the setting of the rental price. Like that's how, because you said they're making a certain rate of return on their money. That's what's driving that, right? Is whatever the rent is set to essentially.
Yeah, so there's a couple of pieces there. The return is roughly evenly split between the rental income, right, and home price appreciation. With a little bit of leverage at the fund level, we can increase the
Sure.
equity appreciation. So the source of return is rental income and home price appreciation. Where that is better, or where we've innovated here, is really around structurally. What we've seen is that the co-ownership relationship gets more of the ownees engaged in maintenance. So we've seen 60% lower maintenance cost compared to standard single family rental.
Right, because now that I own it, I care about fixing the hot water heater, fixing a
Exactly,
leak, the
exactly. I'm not
roof.
going to
Yeah,
let it
yeah.
go into disrepair. We have zero vacancy because we don't buy a home until we have a customer signed up in the agreement, so they pay rent from day one. We haven't seen any turnover right now. Eventually we'll see turnover at scale, but there's significantly lower turnover because you have these 5-year agreements, right? And you have the customer coming in with the purpose of buying the home, so they're not going to default. And
Right.
because so far the average FICO has been 740, so really really high credit quality in the portfolio, we've not had any late payments or any
So it's
issues.
great credit. It's just they don't have the down payment.
Correct.
Uh,
And so, from an investor perspective, all of those things kind of bump up the return, right, to that 15% IRR.
so here's one more question I have, because now I just thought of it as we're talking from a maintenance standpoint. So let's say now I do need to spend 20 grand to fix the roof, and I
Right.
own 5% of the house, and you own 95% of the house. Are we splitting the cost to fixing the roof 95/5? Like, who pays to fix the roof?
The LLC pays to fix the roof.
Got it. Which means essentially we are paying 95/5.
Correct.
Okay.
So largely the the cost for repairs, especially major
Hmm.
repairs, comes out of the investor's pocket, right? Um, and less so out of the customers or the ownie's pocket. The interesting thing is on the flip side, if the ownie says, "I want to make an improvement to the home," right? I'm going to renovate the kitchen and put new kitchen counters
New
in,
cabinets, whatever.
new cabinets. They can do that, and because the way the AVMs work and the way the valuation models work is we ignore that improvement. So they continue buying bricks at the value pre-improvement, and they continue to have the right to buy the home at the value pre-improvement, which means as they make improvements, they actually create an incentive for them to buy the home from the LLC.
Right, because the price is kept down, and it also avoids the fact that just because you spend 20 grand to fix the house doesn't mean you
It's
necessarily
worth
add
20
20
grand.
grand. I mean, it's unfortunately most renovations and improvements to houses do not return the value that is put in.
Right.
Which I speak personally as a person who owns my own house. If you know the industry, it's an occupational hazard because you just realize that any money you spend on your house, you're never going to get it back anyway. So, it becomes a run to failure conversation. It's like, well, why would we fix it if we're not going to get it back?
Right.
No, I
And
get
so
it. I get
we're
it.
avoiding that whole conversation in the first place.
Interesting. Interesting. It's cool because you've actually thought through the structure, and this is why I wanted to get you on, because it is an interesting structure. Um, and frankly, it's not something I've seen before. I mean, I've dealt with timeshare stuff. I've dealt with fractional ownership stuff. I've seen tenant commons or Delaware statutory trusts for like commercial real estate, but this is like another flavor of fractionalization. Interesting, interesting. Um, I wish I could poke holes in it. Honestly, I'm having trouble coming up with. I'm having trouble coming up with negatives. I get the structure. It actually, it's a cool idea. What do you
I
think?
mean, the on the surface, the idea is very simple. Once you get into the nitty gritty of executing it, you realize how hard it is and how much
Right,
you have to build in terms of infrastructure. And we spent 2 years building the legal structure and the math and poking all the holes, right? And then going back to the drawing board and saying, okay, here are all the holes. So if we would have talked 2 years ago, you would have been able to poke a whole lot more holes.
right.
But that was part of the startup cost, and I think that's where we feel good about where we are, right? And the customers feel great about where we are. And so now it's
And
a question of, can we scale both sides of the business while keeping them in balance?
hey, stuff starts out. I mean, all these ideas start out as just a concept and, a small accredited investor group, and then it blows open to, before you know it, it's a publicly traded entity. Yeah, it's fascinating. It's fascinating. Cool. Well, look, this has been very constructive. If people want to check out your website, the address is just ownify.com, right? OWNIFY.com.
Correct.
Um, Always good. I have covered what I wanted to cover, honestly, and I knew it would take about this long. So I'm going to simply say, Frank, this has been very positive. I'm glad we got to go through this. And for anyone who wants to check out their website, they can go to ownify.com. Thanks again, Frank. I appreciate it.
Thanks, Josh. Really appreciate you having me.
Great.